In 2014, Viacom did a study that found at the time 73% of millennials would be more excited about a financial offering coming from Google, Amazon, Apple, PayPal, Square, etc., than their own financial institution. Flash forward now, almost a decade later, and you mentioned Cornerstone. You have Cornerstone reporting that of all of the new checking accounts opened in 2023, 47% of them came from a digital or a neobank or a fintech. Go deeper. Of Americans who opened checking accounts so far in 2023, 72% came from Gen Z or from the millennial perspective. So back to your point, fintech figured out how to meet millennials, and even more so to this conversation, Gen Z, where they're at on their own journey. I think one of the best ways to connect with people is to have conversations with people, understand why they do what they do, what are their questions, what are their concerns, what's keeping them up at night, what's keeping Gen Z up at night, what's bothering Gen Z today at a macro level.
Macro, the biggest financial challenge that Gen Z faces today, undeniably, is how to pay for school. How do I pay for higher education? Since 1985, the cost of higher education has outpaced inflation 6 times each year. It is linearly increased like clockwork. And while there may be the narrative that the federal government is stepping in to fill the void and lend off their balance sheet to no end, that's not true. Private student lending alone has grown exponentially over the last 5 years. From 2016 to 2021, private student loan growth experienced 200% in annual originations between that time period. Now, for reference, that's about a 30% year-over-year growth. In the exact same time frame, auto grew about 3% year-over-year. So the problem for my generation, the number one priority right now that we are looking for from financial institutions is how to pay for school. Now, that exact problem is why me and my co-founders created this business to solve, to help credit unions address that concern without having to underwrite, fund these loans off their balance sheets and service them themselves. I'll keep that aside, but that's the number one thing that my generation is looking out for today as we're considering financial institutions and how they play into our lives.
Well, let's dive a little bit deeper into that, because I think it's an important point to make, because someone might be watching or listening thinking that, oh, I can never get into the quote unquote student lending game. But one of the big narratives that I've had on this conversation are the potential growth opportunities that are available through collaborations. And I think with the work that you're doing, it is a tremendous collaboration opportunity, to the point to where, as we're thinking about strategic growth and strategic growth opportunities, one of the limiting factors for future growth is, that's a great idea, James Robert, or that's a great idea, Harrison. I don't know how we could ever do something like that. But I want to pause that thought before it gets too far and runs away and limits the future potential, because Dan Sullivan, who runs Strategic Coach as a co-founder, and I'm a member of Strategic Coach as a bunch of entrepreneurs, he wrote a book with Dr. Benjamin Hardy that I highly recommend. It transformed my thinking, and it's titled Who Not How. When we think, how are we going to do this, we're already limiting the potential. But when we put the who before the how, well, who do I need to partner with, or who do I need to know to be the how? It opens up a completely different way of thinking and operations and really potential. So when we look at this idea of, okay, Gen Z has a funding issue, or how am I going to pay for education? Credit unions like, that's great. How am I going to do this? I think what you're doing and the work you're doing is the who to the how. How is this possible? Because they don't have to do this themselves. There's a collaboration here.
Yep. So that's exactly what we do as a business. We recognize a couple of undeniable facts that we don't seek to change. One, credit unions are bandwidth constrained. They always will be. Their product roadmap extends 12, 24 months out, and they're not looking to add new things to it. Two, there is not a exorbitant amount of core competency from which to pull on to introduce a student loan program. They don't have it in-house. They don't know how to run it. They haven't in the past. And that leads us to problem number three. It's just not a focus.
Mm.
My chief lending officer, he or she focuses on auto or indirect auto or mortgage or personal credit card, commercial. That's our core focus. So we recognize those facts. We respect those facts. And we say, if you don't want to change them, you don't have to in order to your point, go and address the who, go and address the Gen Z that's looking to engage a credit union for that particular problem. So what we do is we allow a credit union the ability to offer a student loan program without, and this is the huge asterisk, without having to be the lender. So they don't have to underwrite the loan. The loan's not coming from their balance sheet. They're not funding the loan. They are not responsible if the loan defaults. They're not accepting the financial liability on a loan. And they're also not servicing the loan. What they do is they work with us to white label a loan marketplace. And on the back end, we work with existing student lenders who underwrite, fund, and service these loans. Now, the credit union is the star of the show. They're the ones that get to power, somebody going to school and achieving their dream. They don't have to, go through the grunt work of spinning up the program, maintaining the program on an ongoing basis, or worrying about repayment and collection, or reporting it back to the board. So, to your point of trying to find the who, and then working backward to your steady state, like our steady state is we want to be attracting Gen Z. Our steady state is we want to asymptote to bringing in new members into the credit union. We figured out the how. We said, oh, you can launch this loan marketplace without integration into your core in less than 90 seconds, completely white labeled, and you don't have to do any of the grunt work required previously to introduce a student loan solution for members and non-members.
That right there is you've reduced the friction and you've solved a problem for a mass market, i.e., Gen Z. Because, for example, let's play a hypothetical game. Someone in the Gen Z demographic is looking for a checking account, kind of referencing back to the Cornerstone research here. And they're comparison shopping. There's two options. Option A is a checking account. Option B is a checking account paired with student funding capability. At that point, the option B becomes exponentially more valuable because you're solving the specific pain point there compared to just the checking account alone or the commoditized product. Is my thinking on par here?
You're exactly on the money. So when just harkening back to our founding story. So, when after we graduated college, as you mentioned, that's when we realized for the first time, oh my gosh, there were these credit unions on campus that we didn't even know about. Well, the next thing that we did after that, when you feel like a Dutz and you want to figure out if you're not alone, is we asked our friends, okay, what exactly do you want from a financial institution? You're 22 years old. Why do you interact with a bank or a credit union at all? What are you looking to get out of that transaction? Unsurprisingly, the response to that was not, hey, I need to finance a car, or I need to buy a house, or I want to remodel my kitchen, or I'm looking to park $50,000 into a 7-month CD. Of course, those weren't the responses from a 19-year-old. What they were saying was, I need a way to pay for school. And so to your exact point, if you can couple a fantastic ecosystem of existing products that credit unions already nail with that beachhead for younger member growth, that's exciting and that works. And that's what allows you to really turn on the spigot for 18 to 22-year-old to 25-year-old member acquisition growth.
And that's something that I wrote about in Banking on Digital Growth. In chapter number 4, it was around product packaging, packaging up value that might not be the historical or the incumbent perspective, but it is unique to connecting the dot to chapter 3, which was all around consumer personas and identifying their questions and concerns, their hopes and dreams, and really speaking in or communicating into resolving the pain and providing a path forward towards an even bigger, better, brighter future. As we start to wrap up here, I really appreciate the perspective that you've shared into the potential roadblocks, but also the opportunities around Gen Z. What are you feeling most hopeful and excited about with the future of community financial services?
I'm glad you asked the question because often I feel like if you look at the macro perspective, it feels dreary. It feels somewhat hopeless. I mean, it's not a unknown fact that 182 federally insured credit unions shut down last year. By count, that's 4% of the industry. It's not an unknown fact that only 4% of Gen Z banks with a credit union, yet by 2027, they'll control 27% of all global spend and 29% of all global dollars borrowed. So when you couple these things together, one might seem like the future is a little dreary, but on the contrary, I'm here to say as a part of Gen Z, I'm excited by it. You talk about fintechs and how they do an amazing job of acquiring people like me. And while that may be true, they have a really hard time retaining. And I'll tell you why. When we go past the initial checking account that was super easy to open and snazzy and digital first, we recognize that the core service itself does not carry its weight in water when compared to that of a community financial institution. Now, that initial hump that we have to get over to get into the community financial institution might preclude us from engaging the institution to begin. But after you come to the sobering realization that that's where one might want to build financial loyalty, it starts to click. And so what we're here to do is to help that initial hump not exist. We want the credit union to be the rock star of the show from day one, not be the backup replacement once you realize Chime can't support all your financial needs. So we feel that that future is exciting, and it's one that we call Gen Z credit union symbiosis. In that future, credit unions become the de facto primary financial institution out the gate, not plan B. And so, what we're here to do is help accelerate that transition. And we're, looking forward to meeting prospective partners in that regard.
You bring up a very good point, and it might be misunderstanding, it might be misinformation that Gen Z, it's 100% digital. But to your point, you open up the digital account, that's easy, and we're not going to name names, and we've secret shopped those experiences, but when you get to the other side, the quote unquote servicing piece of this and the ongoing relationship, it does for some fall flat. They want a little bit more maybe human experience to support the digital experience. What's your take on that? The balance, the blend between the DX, the digital experience, and the human experience, the HX, through the context of Gen Z?
It's 80-20, and then it flips. So when we're first starting that account, it's 80% digital experience, 20% human experience. The 20% is what our friends tell us. They say, hey, I had a great experience here. It was super easy for me to open up an account. I could get my needs done quickly. The fast, quick, and easy, that is what we're over-indexing on when we're creating the relationship. However, when we're evaluating the relationship, that flips. Now suddenly we don't want to be, some number on an investor deck about how fast account growth is happening. We want to have a relationship with the institution that we're banking with. And moreover, I would argue, we want that organization's values to be aligned with ours, which are often not the case in the world of fintech. And so that's why we're excited. We are excited by the future because of the flip that happens in human experience to digital experience. We just have to ensure that the initial hump for Gen Z and the next generation to engage credit unions is not so large that it never becomes a thought or even an afterthought. So that's what I'd say is 80-20, and then it flips once we start to really experience these accounts and vie for relationships with our institutions.